I'm Charlotte McLeod with investingnews.com, and here today with me is Adrian Day, president of Adrian Day Asset Management. Thank you so much for being here.
Well, thank you, Charlotte, for having me. I always enjoy it.
I also really have a good time speaking with you. And today is an exciting day. It's a Fed decision day, and we're speaking almost just after the news came.
Yes.
We got our 25 basis point hike. So initial impressions from you on that?
Well, 25 basis point was baked in the cake. You know, the Fed funds futures rate were over 90% of investors believing the Fed would raise rates. So that's not a surprise. Obviously, what Powell says at the press conference, which you and I don't know, because is more important. But I think we know more or less what the message is going to be, but we're not going to stop till inflation is down, and inflation's more stubborn than we thought it was going to be, and you know, that sort of thing. And data dependent, of course. We're data dependent. Which, of course, you know, that makes sense. But the problem with data, as we talked before, data is by its nature backward-looking. You get a report today, if you get a report today, it's for June, what happened in June, so it's already out of date by the time the report comes out. But, yeah.
Right, and I had a question on that note, because that June pause was supposed to allow the Fed to gauge the impact of what was going on. So if we're always looking backward, was that really long enough to...
No, it wasn't long enough. That's a good point. It wasn't long enough at all. I also think part of the reason for the pause last month was because you had dissension at the Fed. Some people wanted to stop. Some people wanted a rate hike 50. And the Fed likes consensus. They don't like, opposition and on the Fed, and Powell in particular. So I think they should have paused earlier, but the pause was not unexpected. And Powell, frankly, I'm not an advocate of the Fed or a defender of Powell, as you know, an apologist for Powell. But I think he made a very good case that they've had the most rapid rate of increase rate of hikes in history, from 0 to 5 in basic just over a year is very, very rapid. And it just made sense to pause and see what the effect was. I agree with you. They could have had a couple of months pause, but the problem is, of course, they don't meet in August. So next month is a pause, an automatic pause built in. So I think that gives them a little bit of time to see what happens. But the truth is, as Powell himself has said, and as Milton Friedman said 40 years ago, and as we all know, monetary policy works with long and variable lags, but long lags. And so it takes 18 to 24 months before the effect of monetary policy, up or down, really starts to become evident in the economy. And so, given the rapid rate of hike increases, yeah, you're right. You've got to pause more than 1 month to see what those impacts are.
Well, yeah, if it's 18 to 24 months, we didn't even start hiking. It's still underneath that mark.
Yeah, absolutely. Absolutely. You can see, the headlines in the economy, retail sales or unemployment rate, all look as though the economy is doing reasonably well. But look under the bonnet, or lift the hood, and you see you see things aren't quite as rosy. And we've talked about this before. You look at consumers' sales. If retail sales are moving up by 3 or 4% last year and a little bit less this year, that's less than the rate of inflation. So to point to retail sales and say, well, the consumer's doing well, is totally fallacious, because it means a consumer is spending, the increase in consumer spending is less than the cost of living is going up, which means the consumer is cutting in terms of volume. They're either going to Walmart instead of Neiman Marcus, or they're buying, fewer cereals, or they're doing something, right? They are cutting back. The next thing you see is savings decline. We saw that. Savings have gone way back to before the COVID level. They were built up during COVID, of course. The next thing that happens, once your savings have gone out, is the credit card balances start moving up. We've seen that starting middle of last year. And now, starting this year, we're seeing credit card defaults. So it's a natural progression. You want to keep spending what your kids want for breakfast, what your wife wants, clothing or whatever. You want to keep spending, and you do it out of savings. And when savings are gone, you use credit card. When the credit card balances are so high, there's a point when you can't pay them off. So Capital One, which is a credit card company, but sort of most services the lower income range, Capital One and Discover would be at that lower end. They started having the defaults first, last October, November. But did you look at American Express's quarterly? American Express reported their defaults on American Express, which serves the higher end. Their defaults have gone up threefold in the last 12 months. This is quite staggering, quite astonishing. And that's only going to get worse as interest rates stay high for longer. And that's the point Peter Bookbar has made very strongly, very clearly, but I would re-emphasize, you don't need rates to go up from here. You just need them to stay where they are for a period of time, and more people will start getting hurt.
And meanwhile, we have this kind of mainstream commentary that maybe they're going to pull off the soft landing. Right. So, based on everything you're saying, it sounds like, no, all these things are going to catch up to us, maybe at the point where we expect that soft landing.
Absolutely. You catch up is the right phrase. These things are going to catch up with us. And remember, we had 12 years of easy money from 2009 until 2021. We had very easy money. Excessively easy money and low interest rates. But really, even before that, since Alan Greenspan in the 1980s, we've had easy money. And so there's a long runway, if you like, a big cushion, not for everyone, but a lot of people have savings. A lot of people built up reserves. And so the effects of interest rate hikes just take that much longer to work through the economy. But clearly, just looking at the credit card defaults, looking at the second-hand automobile, the auto loan defaults, clearly we're already beginning to see the effects on that. But it affects different people at different times. So you're absolutely right. It's a good way of putting it, that it's going to catch up with us.
And so, if we put all of this together, we probably want to look at what the Fed's trajectory might be heading out into 2023. What do you expect if we put all this together?
Yeah, I still think we'll see another one or even two rate hikes, but one or even two before the end of this year. Again, next month there's a pause built in. So I think the Fed wants to show that they really are serious about this. So they might get to 6%. 6 is a nice round number. But there is no way they are going to be able to do what Volcker did, which is go from we forget, rates were already double-digit when Volcker came in, but go from 12% to 20% in one fell swoop. It's just not going to happen. It cannot happen. So there's no way that Powell is going to get to 10 or 12%, double the current rate. It's just not going to happen. It can't happen for a lot of reasons. There's too much debt in the economy, which we didn't have back in 1980, or anywhere near as much debt. Debt to GDP was, I shouldn't have said that because I don't know, but it was well under 100%. It's now about 125%. So they just can't do it. And so I think they're going to have one or two more rate hikes to show they're serious, and then emphasize this higher for longer. But higher for longer means that the economy starts to fall into a recession, very obviously fall into a recession. At the same time, I think the consumer price and the PCE will start to move back up at the end of this year and into next year, because partly, for a lot of reasons, but one reason being the decline the increase in the oil price. Energy is not in the core PCE, which Powell likes to follow. They seem to think that ordinary people don't need to or use energy. But oil obviously affects the oil price. Obviously affects the price of gasoline and the price of heating. But it also affects the price of everything else. It affects transportation, obviously, and it affects the price of every good every good we find in the stores, because they're all shipped from somewhere. So as the price of energy goes up, the price of oil goes up, price of goods automatically go up. So towards the end of the year, I think we're going to start to see the consumer price index move back up a little bit. I'm not looking for 10, 12, 15%, but if it goes to 4% and is stubborn at 4%, you've got persistently high inflation, you've got high interest rates, and you've got a declining economy. I think at some point they're going to have to cut. Now, again, I've been a lot more cautious on this than a lot of my friends. I think the Fed is going to hold off cutting rates for as long as they can. If you look at the Fed dot plot, which is the individual estimates of the Fed members, most of them are looking for lower rates by the end of next year, which is kind of a bit surprising. I think Powell wants to keep them higher for longer. I don't think Powell cares too much about the stock market. I don't think he cares too much about the economy or unemployment. When I say I don't care, I don't mean, he's heartless. Maybe he is, maybe he isn't. I don't mean he's heartless. But I mean, he's not going to cut rates just because the unemployment rate moves up. As I've said before, the Fed wants higher unemployment. They don't come out and say our policy is higher unemployment. They want to lower aggregate demand. How do you lower aggregate demand? By increasing unemployment. So they want higher unemployment. So if the employment rate goes up to 4 or 5, maybe 6%, I think they will tolerate that. It's only if the unemployment rate gets completely out of hand, 9 or 10%, or if we have other things break in the economy, like more banks, insurance companies, pension funds. If we see other financial institutions break, then the Fed will have to cut rates.
Okay, I think we've got a good picture, hopefully, now of what's going on with the Fed. I'm going to take us over to gold as well.
Okay.
So I want to talk about your presentation here at the Rural Symposium. It has a pretty bold title, and I think the topic is definitely on everyone's minds here. So it's why has gold not performed and what will make it move? So I guess my first question is it true gold hasn't performed?
Funny you say that, because I started my talk, apart from saying what a coincidence it was while I was talking while Powell was talking, I started my talk by saying I actually disagree with the premise of the title.
Here we go.
I think it's false to think that gold hasn't performed, but everybody always says gold investors always have unrealistic expectations for what gold should be doing. We always do. Because I'm a gold bug, we always have unrealistic expectations. And gold's function as an insurance, as a hedge, is not to double and triple in price. It's to preserve our purchasing power. And so last year gold was flat, and in that, with the headwinds of a strong dollar and interest rates moving up dramatically, that was actually strong performance. And if you look at gold in terms of virtually every other currency in the world, it did very well last year. So yeah, the premise is wrong, and I did that deliberately. But what will make gold really move? And I looked at different factors, and I'll cut to the conclusion, but I looked at different factors that people think affect gold. Geopolitical, very little impact on gold price historically. And we saw that with Ukraine. Big spike and then back again. And that's historically true. Consumer prices going up, otherwise known as inflation, although that's an incorrect definition of inflation, but consumer prices going up does not necessarily correlate with gold prices moving up. And that's a mistake. And we saw that in the last 12 months. Everybody was surprised. But we've also seen that historically. What really affects gold is investors' perception of whether the central banks will raise rates enough to kill inflation. So you can have rates continuing to move up. We saw that in the 1970s. People forget when Arthur Burns came in after the recession of 74, 75, Arthur Burns raised rates every single quarter. The CPI was moving up, and Arthur Burns was raising rates every single quarter. But people did not have the confidence in Arthur Burns to raise rates enough to kill inflation. And they were right. When Volcker came in, rates were already double-digit. Let's not forget that. When Volcker came in, people had the confidence to think, by golly, this guy's really means what he's saying. And he's a gruff, he's dead now. He's a gruff man, smoked a cigar, didn't smile. He said, I'm going to kill inflation and it'll mean a recession. And people believed him. And they were right to believe him. So it's a matter of investors' perception of, will the Fed do what's necessary to kill inflation? And you've seen in the last year, when there was all the talk of pivot, gold moved up. When the Fed paused, but Powell came out and said, we're going to continue raising rates, gold came back. So, the last 12 months has validated that sort of concept. Now gold is beginning to move back up because I think this hike was baked in the cake, and people can see, but we are clearly close to the end of the peak in rates. Powell is not going to go to 10 or 12% interest rates. And so we're close to that peak. And so I think investors are beginning to feel they're going to stop. The Fed's going to stop, whether it's now or 2 more 25 basis point hikes. 25 basis points when you're already at 5.5 is not a lot. 25 basis points when you're at 0.5% is a lot. So we're very close to the end of the rate hikes, but inflation is not yet destroyed. And so the market is sensing that.
Okay, all right, very interesting. And I have to, of course, also ask you about the gold stocks. So we know that in the environment that you've been outlining, this is probably going to end up being positive for them in the long run. And do you think people might be getting a little bit tired of waiting? So any words for them?
Well, we've been through these cycles before, haven't we? Where people are get tired of waiting. And the one thing I will say is that I can guarantee you that the day you give up is the day the gold stocks will turn. Gold stocks typically lag the gold. We've had good moves in the gold stocks. This month, a little bit of a pullback, but good moves. But I think people are waiting for gold stocks will move when two things happen. One is when gold moves consistently above 2,000 and stays there, because it's been above and come back, been above. So if we get gold over 2,000, and then, for 1 month or 2 months or 3 months, it moves up, doesn't have to move up a lot, but just moves up and stays over 2,000, I think we'll start to get more interest in the gold stocks. And equally, when the broad market rolls over, I don't think we're going to see a market crash. I've never been thinking, I don't think we're going to see a market crash right now, but we're going to start seeing slow rotation. You rotate out of, the NVIDIAs and the Teslas and the Apples, and you then rotate from growth and tech to value. And what is the best value right now? The best value right now are the oil stocks, the gold stocks, are the commodity stocks. The gold stocks, as we've said before, the big cap names, the good quality companies, they're cash positive on their balance sheets, which is astonishing in a capital intensive industry. And they're in the lowest quartile of their historical valuation levels. You look at it and you go, you look at the XAU, frankly, and you look on price to cash flow, price to free cash flow, price to book value, a lot of metrics, they're in the lowest quartile of their last 20 and 30-year historic average valuations. That's crazy when gold is at 1950. 1950 is not a bad price. Let's really remember that. And you look at the margins, the all-in sustaining cash price of cash cost of gold is between 12 and 1,300. So if your all-in sustaining cost is 1,300 and you're selling for 1,950, that's a pretty good margin. The margins aren't as good as they were 1 and 2 years ago, but over a 20-year basis, they're much closer to the top than they are to the medium, let alone to the low. So the margins are strong, the cash balances, balance sheets are strong, and the outlook is strong. So, I think the gold stocks are just amazing buys right now.
I think that's a very nice place for us to wrap up,
Okay.
unless you had any final words.
No, not really. I'm sorry I keep leaning. Sorry.
No, thank you so much for coming. It was always nice to talk to you. I think that was a great
Thank you. Thank you.
All right. And once again, I'm Charlotte McLeod with investingnews.com. This is Adrian Day with Adrian Day Asset Management.
Thank you. Thank you for having me.
Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.